Hey everybody, Matt Ramuzzi here from CapForge Bookkeeping and Tax, and I'm going to talk about how to do due diligence when you're buying an online business. This is something that we have done a ton of, and I have personally done. Well, I bought a catering business. You can see beckerscatering.com. It was actually a brick and mortar catering business, but they had a website too. Way back in the day, I did my own due diligence in buying Becker's. Ended up buying it for, I forget, it was around $600,000. Grew it for 4 years. When I bought it, it was doing about $700,000 a year. When I sold it, we were doing 1.4 million in sales a year. Sold it for a nice price, sold it myself, and then I got into business brokering, and that was a lot of business valuation work. And then some years after that, I started the current firm, CapForge Bookkeeping and Tax, mostly because I saw how bad most small businesses were with bookkeeping. But one of our main sources of clients for the bookkeeping and tax work was business brokers and people who are buying businesses, people who are selling businesses. And so we've done a ton of work. The Becker's guys were kind of shady, and the due diligence definitely was important there to find out what they were not telling me. Um, and since then, and the 400 plus projects that we've done just in the last 3 years, I've learned a lot about how to check out a business and figure out if it's something you want to buy and what the right price is, and how to understand what is and isn't true about what the sellers may be sharing with you. So that's what I'm going to talk about today, and that's where my experience is coming from. I have been in the hot seat. I've borrowed the money to buy a business. Fortunately, I made it work and had a good experience with it. But I've seen plenty of people who've, made mistakes and gotten in over their head and bought things they didn't check out well enough. And so my job now is to really help people not make those mistakes, understand what they're getting, how to figure out what the right price is if you want to proceed even at all, and then how to make sure that you really understand what you're doing and you're getting a good business for your money, not a bomb. All right. Yeah, and of the 400 plus businesses we've done in the last 3 years, 75% of them were online, either e-commerce or other kinds of online business, content, SaaS, agency businesses, etc. All right, so here we go. Financial due diligence. So what is due diligence? Let's just start with that. It's just basically checking out the business that you plan to buy. If you're buying an online business, the good news is, there's a lot less to check out. With the catering business or brick and mortar business, not only are you checking out the financials, but you got to make sure the building's in good shape, the equipment's in good shape, the staff, everything that comes with it. With an online business, a lot of times it's just the owner selling it, and there is no physical equipment or assets that are coming with it. So the good news is there's a lot less to check out. What you're trying to figure out in due diligence is you're making sure that what they're saying it made as far as profits and revenue and expenses is real. Those numbers are accurate, and you can use them as a basis to determine whether or not you want the business, and if you do, how much you're willing to pay. And don't make the mistake of thinking that what they're asking for it is any relation to what you should be willing to pay, right? They could be asking $1 million. That doesn't mean a good offer is 800,000. That just means they would like to get $1 million for it. A good offer may be 100,000, or it may be zero. Or once in a while, you might be willing to pay up to $1.3 million, and they're only asking one, in which case they've priced it at less than it probably is worth or you'd be willing to pay. But a lot of times people start with what the asking price is and try to work from there. But really, the asking price has nothing to do with it. The next part of due diligence is making sure that you know how much you can actually make from that business, right? If you're not sure how much it's going to make for you, even if you know with a high level of confidence what it made for the last person, then that's a red flag. You don't want to go forward until you're sure you understand how much it will make for you. And that may be different. It often is than what it made for the last person. So what do you want to ask for when you're doing due diligence? You want to ask for tax returns. That's the single best source of understanding what this owner, the current owner, is reporting to the government as far as what they made. And a lot of people will tell you, well, yeah, on my tax returns, I report a loss because I don't want to pay taxes, but that's not really what happened. All right, well, you told the government the business lost money. So you've just upped your burden of proof to show to me that you really did make money, because what you legally reported is that you lost money. So if their returns are showing losses, they've got more work to do to convince you that this thing really does make money. And if they can't do it, obviously, then it doesn't matter again what they're asking for it. It's a good one to walk away from. So tax returns are a key thing to ask for. Now, if they haven't filed tax returns, or they aren't willing to share them with you, or they're outside the US where the tax return filing requirements may be different, then you have to decide what else you're willing to accept as proof. But tax returns are a great place to start. And of course, you want to see bank statements. You want to see actual deposits and expenses from the business, not just the sales platforms, Amazon reports, or PayPal reports or something. Those are good to have also, but you want to really see the money hit the bank. You want to see financial statements, which is the profit and loss, but also you want to look at the balance sheet, and if they've got them, cash flow statements. Generally speaking, the more information you can get your hands on, the better. The more likely you are to catch something you might have missed if you hadn't asked for it. And again, the more you're seeing that they really have the information, right? If somebody just photoshopped one set of statements, but you ask for 3 or 4 sets of statements, it's a lot more work for them to fabricate the whole thing and make it all work. Which, if they won't provide anything but one set of statements, one kind of statements, then that's a red flag. If they've got tax returns and financials and bank statements and everything matches, that's a pretty good indication that they didn't just make it all up, and that's really what the business was doing. You do want to see those platform statements. If they're selling, an e-commerce seller selling on Amazon, that is a great indication and a trustworthy indication of how much they really sold. Doesn't tell you anything about how much profit they may have made, but at least you know how much they sold. Same with PayPal or Shopify, Etsy, or affiliate payout programs, or Google AdSense reports. You want to see platform reports, and you want to make sure that, again, those match other platform reports that you've seen. They don't look a little funny. They don't look homemade. I would say 99% of the sellers out there that I've seen are not fabricating stuff to scam people. I think that happens more in the lower end of business sales. And the smallest businesses are more subject to people playing those games. So if you're buying a small business, say under 20K, be more mindful of the fact that they may have fewer documents to show you, but also that those documents, you need to be able to make sure that the source is legitimate, and nothing's been changed on them. So the more information you can get, if there are any physical assets, equipment, make sure you get a list of what those things are and what their value is. If it's an e-commerce or an inventory-based business, make sure you understand what inventory is included, and ask for sample invoices so you know really how much they paid for it. Not necessarily, again, cross-checking with whatever other financial documents they have. If there is a space that you're going to get, you want to see the lease. If you're not sure what to ask for or what would be good proof that the business is legitimately operating the way it is, that means you didn't do enough homework. You don't understand the business well enough if you're not even sure what to ask for. And that in itself is a red flag that probably means you're not ready to spend the money to buy it if you don't really even understand what you need to be looking at to make sure that it's operating the way they're claiming. So once you get the docs, or getting the docs, I guess, if they've got a broker, hopefully the broker has prepped the seller to be able to provide these things and it's ready. You also want to make sure you're looking at current stuff, right? If you're buying a business today, which is January 2024, and they're trying to show you numbers through the end of 2022, well, that's not going to work, right? 2023 has come and gone. They should have numbers through at least November or December of 2023 if we're here in January 2024. Anything older than a couple of months is too old, and you need to ask for the updated results. Tax returns should also be filed through the most current year that the deadline is for, right? So again, in 2024 for the US, deadlines for business returns is March 15th and personal returns April 15th, right? And if they're trying to sell the business, they should be on top of that, have current numbers, and get their tax returns filed. So if it's June of 2024 and they're saying they still don't have their tax returns, legally, yes, they could be on extension, but you should push them to get those completed and provide them as part of your due diligence. And the seller should be open to providing these. They should be willing and able to give you this information that you're asking for. If they're saying no, or they don't understand why you want to see it, or they want to go through and black everything out with a black marker before they hand it over, yes, they can black out bank account numbers, or sensitive information, but they shouldn't be blacking out every other transaction. That is not a good sign. They also shouldn't take weeks to get this to you, or months even to get this to you. They should have it readily available, and they should be willing to share. They should act like they have nothing to hide, because if they're acting like they have something to hide, they might have something to hide. Some people are just super private, but those sellers then have to understand they're going to have a hard time selling their business if they're not willing to provide proof that it's doing what they're claiming. All right, so on the subject of red flags, what should you be looking out for? So seller refuses to provide key documents. That is instantly a red flag. If they can't really prove what they're making, then obviously the only conclusion you can draw is that they're not really making what they're claiming. That may not be actually the truth, but it doesn't matter. If they can't prove it and they won't provide documentation, then you should treat it as if they're not making that. If the seller shows losses every year for tax reasons, like I said, they should be able to clearly document exactly what they were claiming that created the loss that wasn't really required for the business. If they can't, then you don't want to just take their word for it. Look, I just didn't want to pay taxes, so me and my accountant came up with this so we could show losses. Well, that by itself is not an explanation. You have to have a reason to show, a way to show that you actually did make money. And if you can't draw a very straight line between the income you had and the true expenses and a profit, then chances are you really were losing money, or at least not making nearly as much as you're pretending. If business, excuse me, if this business that you're buying is commingled with other information, other businesses that the same owner runs, and it's all mixed together, and they're saying, oh, don't worry about these expenses, they go with my other business. Well, that's not a great situation. You don't know as the outside person whether or not that's true or not, right? They might say, oh, I paid this marketing person for the business that you're looking at, but really they were working on my other business. So you don't have to include that expense. Well, unless they can provide really good substantial proof of that, then that's not necessarily what you should expect. And that person may have been working their butt off on the business that you're planning to buy, and the seller's telling you, don't worry about it, you wouldn't really have to spend that. It's a red flag. If it takes forever to get answers, that's a problem. Again, the sellers should know that they're planning to sell. They should have their act together. They should be ready to get things to you. If every time you ask for something, it takes 2 or 3 weeks to get it to you, yes, they could just be busy. But I also then I'm always suspicious. What are they doing? Why is it taking so long? Are they making these things up? Are they working in Photoshop? Or they hired somebody to Photoshop stuff that then they're going to try and provide to you? It shouldn't take 3 weeks to get a bank statement. It should take a day or two. Also, if there's a sudden big jump in performance with no clear explanation, the business was losing money all along, and then in the last 6 months, all of a sudden revenue jumped up, profits are huge, everything's amazing, but all of a sudden now with this great performance, suddenly they want to sell, that's a red flag. That's something you want to look into. Why did suddenly things jump up? Why things are suddenly so good now? Now is when you want to sell. It just doesn't make sense, right? What you're looking for is something that makes sense. When somebody tells me they want to sell their business and retire, and they've been running it for 30 years, I go, yeah, somebody who's been running a business for 30 years wants to retire. That makes sense. Somebody who's in their 20s and running a business 18 months, and they tell me they're selling the business because they want to retire. No, you're not selling this business for enough to retire in your mid-20s after you've been running it for 18 months, right? It just doesn't make sense. So trust your gut. If something makes sense, then it probably is true. You still want to check it out, but at least it doesn't immediately make you go, well, that doesn't make any sense. If you keep hearing that phrase in your head, that doesn't make sense. That doesn't make sense. It doesn't make sense. And let your gut be your guide on that and walk away, or at least make sure you dig in a lot harder and really know what you're getting. Because if it doesn't make sense, it probably doesn't make sense. So when you do the financials review, you want to look at the profit and loss by month and the balance sheet by month. Not everybody digs into the balance sheet, but there's a lot of good information on there as well. The profit and loss tells you what the income and expenses were each month. What you're looking for is consistency and things that, again, make sense. If they're doing cash or accrual, you want to look at both, or cash and accrual. You want to look at both. If they're only doing cash, well, that's all you have to look at. If you're not sure what this stuff means, this is something that you probably want to get some help on. You want to make sure they're profitable each month, unless they're a super seasonal business. An e-commerce seller may have some unprofitable months and make it all up in the last quarter around the holidays. But for any other kind of business, a content business or a SaaS business, an affiliate model, you hopefully want to be profitable each month. If you have ups and downs, then how do you know after you buy it, you're not going to see a string of down months and run out of cash before you get to another one of those up months? If you do, right? So the more consistent and profitable it is each month, the better a deal it's going to be. You also want to see consistent ratios and expenses. One, this is just a sign that the accounting was done well. And two, it's a sign that the business is stable, right? If one month the ad spend is nothing and the next month the ad spend is 10,000 and the next month the ad spend is back to $1,000, that makes for an unpredictable and hard to manage business if that's really what they were doing. Even if that's the rhythm that business actually works in, you want to make sure you understand why. But ideally, you're buying a business that has consistent, predictable rhythms, cash flows, expenses. The more unpredictable and wavy and up and down it is, the harder it's going to be to manage and the less predictable any future activity is. You also want to see, is it growing? Is it flat? Is it declining? Ideally, you want to buy a growing business. If it's flat, you want to understand, why did it level off? And honestly, very few businesses are flat. They're either growing or they're declining. That plateau stage never lasts very long. It always picks a direction. If the business is declining, that doesn't mean you're getting it at a deal, even if the price seems pretty good. If the sales are going down, you absolutely want to understand, can you turn that around? Because if you can't turn it around, then you just bought the headache off somebody else. You let them walk away with cash, and now it's your sinkhole. So make sure you understand if it's declining, why it's declining, and if you have an absolute sure plan to turn it around. Because if you don't, let them hang on to it or sell it to some other sucker. You don't want to buy that problem. You also want to see, is there unusual activity? Like I mentioned, is all of a sudden the last 6 months just spiked up. Now it's suddenly profitable and now they want to sell. Look for stuff that makes sense. Again, too, judging the quality of accounting, the more weird the numbers seem, off, unusual, that's probably a sign that the numbers aren't right. And you want to dig in that much further to understand what the true numbers should be. And again, if this is stuff that's all kind of out of your league, then get some help with it. Don't just take the seller's word for it or hope that the numbers you're looking at are right. All right, tax review. If you get the tax returns, which again, I think that's really a key thing you want to look at. You want to make sure they match the financials. You want to see if they're reporting a profit. And that's right on page 1 of the tax return, income or loss. You want to see a positive number there. If they're paying themselves through the business, you want to make sure that's noted and see that it matches what they're telling you. You want to review statement 1 on the tax return, which is where it shows all the expenses. If you're planning on buying this business with an SBA loan, the lenders are basing their decision to lend to you on the tax return. So there might be financials that show a profit, but if the tax returns show losses, the SBA is going to have a hard time loaning you the money. So you want to see the tax returns and make sure they match the financials. Excuse me. And if they don't, understand why not. And if that discrepancy is something that the SBA is going to live with, because a lot of times they won't, and that will kill the deal. When you do your bank review, you want to make sure that the deposits are matching the revenue they're claiming. You also want to make sure that the deposits aren't coming from transfers, right? Transfers from another savings account or another business the owner owns, right? You want to see deposits that are a result of sales, merchant account deposits or bank deposits or transfers in from Amazon or Shopify or what have you. You want to make sure that the deposits match, but also that you're not just looking at bank balances and seeing transfers that are making up the difference. If you see a lot of transfers into a business, that usually means what's happening is the business itself is losing money and the owner's having to fund it to keep it afloat from other sources, which obviously is not a business you're going to want to buy. Also, same thing, if they're borrowing money from a line of credit or they're getting lots of loans, that's a problem. You only get a lot of loans with a business if you're having cash flow problems, and you don't want to buy a business with cash flow problems. You also want to kind of see the average balance trends. If over time more money keeps going out than coming in, even if they're not transferring in or borrowing, that's a business that's in trouble. I was just looking at one this morning. It started the year with $200,000. It ended the year with $50,000 balance. Yes, money came in. They had sales every month, but what that means is more money was going out than coming in. And unless you can trace that to owner distributions accounting for it, then you want to be careful with that business. Do they have a lot of overdrafts and NSF fees and canceled checks or return checks? If they do, again, that's a business with cash flow problems, and that's not a good sign. That's not a business that you want to walk into lightly. SDE review. So SDE is seller's discretionary earnings. It's profits plus any expenses that the business owner included that weren't really needed for the business. So let's say you have an online business, you sell exclusively to people who order through your website, but they include auto expenses in the business and they include meals and entertainment, right? Neither of those things, you don't really need a car to run the business. You don't really need to take clients out to dinner to run that business. They've included it to help lower their tax bill, but they would be added back to the profit when you're looking at how much money does this business actually make or can it actually make. So that's what the SDE is. And that's really what you're basing the price you're willing to pay for the business on. Some businesses don't have any add backs. The smaller online businesses, a lot of times they don't even include any add backs. The bigger the business you get, the more likely you are to see at least some add backs. Now, when you're looking at the add backs, you want to make sure they're well documented. They have proof that these really were what they spent on the business. You want to have not a ton of different add back categories. You want to have a business ideally that's profitable even before you include the add backs. You want to have the add backs that they're claiming match what they put on the tax return, that match the financials, and that these are the same add backs that a new owner would also be able to take advantage of or not have to spend. And you want to understand if there's depreciation and amortization that was included as an add back that isn't the result of actual equipment or things they really had to purchase. Again, I'm getting into kind of more in-depth accounting stuff. So if this is something that you see on a deal you're reviewing and you feel like it's over your head and you're not sure exactly how to evaluate it, definitely want to get some help on that so you don't make a bad decision based on not really understanding what you're looking at. The smaller online businesses, again, most of this isn't going to apply, but you get into a business with even $100,000 price tag, you're going to start to see all this stuff. And the bigger the price tag, the more likely that all these are things you're going to want to be able to evaluate and understand. So what are the acceptable SDEs? So one owner's compensation. If you're replacing one owner as the new owner that's buying it, that makes sense. But if they've got multiple owners, then you only want to include one. If they've got meals and travel, but that's not required for the business, that would be all right. If they're paying interest, you may still be planning to pay interest too if you're using a loan to acquire the business, but their interest is not going to be your interest. Personal stuff is okay as long as it's truly personal and they've documented it. Home office expenses, fine. You again can claim that for your side, but yours isn't going to be the same as theirs. Depreciation and amortization, as long as it makes sense for the business. And if they've got non-working family on payroll, that would be an acceptable add back. Basically, anything they want to claim is money that you as a new owner would be able to freely spend however you wanted. has to be documented, and you have to be okay with what they're claiming. It really has to not be needed for the business. And this is a place where a lot of sellers will want to fudge it, because the more they can claim, the higher their profit, the bigger the price they can ask for. So you want to make sure you're knocking down any add backs that they're claiming that don't really work. All right, so suspect SDEs, if there's if they're claiming all the owners, and not just the one, if they're lumping in personal expenses with, just round numbers, obviously not well documented, not a number you can trust. If they're taking back one-time expenses, but they're not really explaining what they are or why they're only one-time expenses, you want to make sure you understand that. Add expenses for failed efforts. Well, that's not necessarily an add back. You really have to understand if it generated any revenue, even if it wasn't profitable, and add or take out everything as the result of that ad campaign, not just the ad expense. R&D expenses, again, you want to make sure those aren't legitimately needed for the business. And anything that you can't prove didn't have some impact on the business, even if it wasn't the impact they were hoping for, that doesn't make it an add back. All right, so let's say you've gone through the process, you looked at all their numbers, you looked at their tax returns and bank statements and everything, and you come up with, this business doesn't make as much as I thought it was. What do? Do you walk away? Maybe, maybe not, right? If you can negotiate it down to a price that now makes sense for what you think the true performance is, well, that's worth a shot, right? So you use the issues you found as the basis for a revised offer. Hey, you told me this was going to make $200,000 a year, but I can only prove to myself that it makes 150,000. And here's why. Here's all the things I found that don't add up to 200, that only add up to 150, right? On the basis of that 150, here's my revised offer. You don't need to document everything or prove somehow that with math, 150 is the new right number instead of 200. You just say, look, I found a bunch of things. They don't add up to what you tell me. So here's my new offer. And you also want to remind them that, every other person who looks at their business, let's say they want 200, you tell them 150 as the price. They say, forget it. Okay, you can, say that, but anyone else who looks at this business is going to find the same stuff that I found, the same problems, the same discrepancies, the same issues, and they're going to lower their offer, and their offer may be 100. And in the meantime, the business may not do as well, or, who knows, anything can happen. So yes, you can reject my offer because it's not the 200 you were hoping for, but anyone else you show this to is going to see the same thing. So you might want to just negotiate with me, see what happens. And also, keep in mind, like I said at the beginning, the right offer has nothing to do with their asking. I hear people all the time tell me, well, they're asking 500,000. I'm only willing to offer 250, but I don't want to embarrass them with a low offer, or, I don't want them to be mad and say I'm lowballing them. Look, it's business, right? And the price that you're willing to pay or have determined through your review that you're willing to pay has nothing to do with what they're asking. They can ask anything they want with great relationship to what the business has done or no relationship to what the business has done. What they're asking has nothing to do with what the right price for you to pay is. So don't let embarrassment or anything else hold you back from standing firm on what you think the price that you want to pay is going to be. So let's talk a little bit higher level. I know I just went through a lot of detail. Let's talk a little bit higher level about what makes a good buy, because this is really the critical piece of due diligence, thinking about a business to buy. What makes a good business? So number one thing, in my experience, 400 plus deals of what makes a deal a good deal is that you understand the business well. You understand how it works. You understand why customers choose to do business with that particular business, and you understand what can go wrong. The less you understand the business you're buying, if you're just hoping to buy it as a cash generator, as passive income, as something you just plug and play, and every month you get checks to deposit, it's not going to work out. Things are going to go wrong. You're not going to know what to do. You're not going to know how to fix it, and you're going to end up losing your investment. And I don't say that to scare you. I say that because that's the reality that I've seen over and over. If you don't understand the business, then how are you going to expect to run it successfully? right? You really need to understand what you're buying, why it works, what its secret sauce is, what makes it magic, what makes the customers pick it, and what you can do to grow it. You have to be able to grow the business that you buy if you want to make it really work as an investment. Because, like I said earlier, a business is either growing or it's declining, right? There's no real middle ground. So if you're not sure how to grow it, or you don't have any plans to grow it, or you're just going to keep doing what they're doing and they didn't have great success with growth, then it's going to start to decline. And the faster it declines, the less return you're getting on that investment and the more likely you are to lose money. So you have to understand how to grow it. The beauty of being able to grow a business is that the price becomes much less important, right? Let's say you pay $20,000 for a business, but 2 years from now, it's worth $100,000. Right? Then whether you paid 20 or 25 or you got it for 15,000 as a deal doesn't really matter because it's worth 5 times now what you paid for it, or 4 times, or 6 times. Point is, it's worth a heck of a lot more than just a few years ago when you bought it. But if you buy something for 20,000 and a year later you could only sell it for 10, well, then that 20,000 really feels like you way overpaid. Right? So the best way to make sure your investment is solid is to make sure you can grow the business that you're buying a lot. You also have to make sure you have time for the business. Again, the idea that you're going to buy something that's passive cash flow, very, very few businesses are truly passive cash flow. And most of the time, that's only after you've done a lot of work to set it up to be that way. And you have someone else who's actively managing your passive cash flow business. But if you don't have time for it and you're just hoping to throw some money at it to make more money, you're better off buying a dividend producing stock or something else that truly can be hands off. And yes, the return won't be as high, but you also won't have to work on it. But a small business requires active management by somebody. And if you don't have the time for it, then it's not likely going to get you the results you want. It also really helps if you like the business. It's hard to spend time and focus and work on something you don't care about. And you can say, well, I care about the money, but that's hard to sustain you, right? If I was to buy a business that, specialized in needlepoint, right? I don't care about needlepoint. It doesn't hold any interest for me. So I would have a hard time focusing every day on engaging with the needlepoint community and finding out what they wanted to buy and writing blog posts and doing video content around needlepoint because I just don't care about needlepoint. So it really helps if you get a business that you enjoy, that you understand, that you want to engage with, that you like the community, that you know the customers, that it's something you'd be interested in, even if you didn't own a business in it. This isn't a deal killer, but it's definitely something that really helps. If you're deciding between two businesses, let's say one's fishing and one's needlepoint, and you really enjoy fishing and you really could care less about needlepoint, then get into the fishing business because you're going to be a lot more interested in that. You're going to engage in it and you're going to be a lot more successful if you care about it versus the one you don't care about. All right. And then finally, of course, you got to make sure the price works, right? Don't stretch to buy something with hope as your strategy just because you're enticed by that bottom line number. Boy, it would be great if I could buy this business and have an extra $50,000 a year to spend, but it's a stretch. You don't really understand the business. You're not really sure if that's what it makes. It's not going to work. You've got to make sure that the investment works for you and that if it didn't work, you could live with the fail. And if it does work, you're buying it at a number that makes sense. All right. So finally, I got some questions as if this was, I guess, a live Q&A. They gave me some questions to go through and address with you guys. So let's do that now and see what else we can answer here. All right. So what are the main red flags you see when buying a business? The number one is it just seems too good to be true, right? Why is the price so low? Wow, it's so profitable. Wow, it's only been open for 18 months and the guy already wants to sell it and it's doing great, and he's asking a very reasonable price. Well, it doesn't make sense, right? If you had a profitable hands-off business, a business that made $10,000 a month, you only spent 2 hours a week on it and you only had it for 12 months, why would you sell that, right? Wouldn't you, even if you didn't have the 2 hours a week that it takes to make 10 grand a month, wouldn't you hire a VA or a manager or somebody else for $3,000 to spend those 2 hours a week to run it, and then you still get to keep $7,000 a month and keep growing it, right? If it seems like, wow, this business is so awesome, why would you be selling it? And they don't have a really good answer, like, I just found out I have stage 4 cancer, I have 4 weeks to live, and I have to get rid of it so I can get some money for my family. And by the way, I'd want to make sure, I mean, that sounds callous, right? But you want to make sure that's really the true story. They really have a family and they're really sick. But if it seems too good to be true, be suspicious. That's normal. And you should, again, trust your gut. Are there any business models that are more risky than others? Yes. If it's content, SEO based, right? Those things can change on a dime, right? It's ranking in the top 3 results in Google for 30 keywords, and that's all the traffic, and all the traffic is what generates all the revenue. But that's the only thing that generates the revenue. And then Google does one of their algorithm updates, and all of a sudden the traffic drops by 90%. Right? What do? If you're got any single point of failure like that, or a business with one customer, and I've seen them, it's a wholesale business and the whole business is set up around selling to one customer. What happens if that customer decides to go somewhere else? Then that business just went from 100% to 0%. But if we're talking about online businesses, the riskiest ones are where it's content based, SEO based, and the only thing keeping them going is the fact that they have good organic rankings, because those can go away. You want to have a newsletter, you want to have an email list, you want to have customer engagement that doesn't rely on SEO. Yes, SEO and organic content can be one of the ways that you get traffic and customers, but if it's the only way, that's very risky. So, do I work with anyone that provides funding for these kinds of businesses, and does that affect due diligence? So we covered that a little bit already. Yes, we work with a lot of SBA lenders. They are generally looking at deals that are $200,000 and up. They use the tax returns to vet the lendability of the business. So you have to make sure that the business you're buying would qualify for a loan. If you're hoping to use an SBA loan, it is a little bit going to limit the kinds of businesses by size and by reporting requirement that you're going to be able to fund. When should you do due diligence? Is there anything you don't check that I should verify myself? Yes. I mean, I would check to see whether or not you understand the business and you have a solid plan to grow it. Not just, I'm going to throw some Google ads at it, that should work, but a solid understanding of the business and how specifically you would expand its reach. So that's not something I can tell you in due diligence. You're going to have to understand your role in acquiring the business, managing it, and growing it. And that's something you absolutely need to check out before you buy it. You have different or cheaper services for smaller acquisitions. Yes. So, the more complex the business, the more involved the due diligence is going to be. But on the flip side, if it's a very simple business, they only sell, one platform, they only use PayPal to collect money, it's not going to take much time to check out. And the cost to do that, to help with that process, is going to be a lot less than for some of the bigger, if it's $1 million business, the price for checking that out is going to be a lot more than the price for checking out a business that's 10,000 or 20,000. And if I'm buying a business, something small for my first business, less than 10K, is there anything major I should look out for myself? Yes, the biggest thing for a business that small is just make sure it's not fake. The smaller the business, the less you're expecting in the way of documentation, which means the less work there is for that person to do to fake it. And if you live in a country where $5,000 or $10,000 is a year's more worth of income, then the incentive for somebody to fake that kind of business is a lot higher, and there is fraud out there for sure. So consider the origin of the seller, where they're coming from, the level of documentation you're getting, and the level of proof that they're providing. And can you legitimately go and check out that business and see if it's real or not yourself, without just relying on what the seller is providing you. But the other question is, if a business is $5,000 or $10,000, why not start it yourself? It's a question. Really, any size business you're looking at buying, there's always a build or buy decision. If you're buying it, presumably what you're getting is all the hard work done in setting up and establishing the brand, the content, the traffic, the customers, the pricing, the offers, the inventory, everything else, right? That's what you're getting. You're getting immediate cash flow for what you're paying. But if it's a business that's only $5,000 asking price to begin with, then how much traction does it have? How much history does it have? How many customers does it have? And what would it cost you to simply start your own in the same category doing basically what that same seller is doing? And if the answer is, I could start this business myself for $1,000 and in 5 months be at exactly the same place you're at now, and you're asking me to spend $10,000 on it, then that should at least be something you consider. How much would it cost you to just build this yourself? And that also helps you make sure that the asking price is reasonable for the amount of time and effort you're going to spend, and the money you're going to spend to replicate the business. Is the price they're asking about what that would cost you? If not, if they're asking way more than it would take you to just get the same thing yourself, then the price doesn't make a lot of sense, right? Or if the price is less than it would cost you to replicate it yourself and everything else looks good, then that sounds like a good deal. And then the last question here, which marketplaces and brokers do you work with? All of them, really. We work with all the brokers, all the marketplaces. We work with really buyers, right? The buyer of the business is who we work with. So wherever you found the business or whatever broker you're working with, we're happy to work with those people as well. All right, so let's wrap it up here. If you have questions, I know I went through a ton, so you may have to watch this recording a couple times and take notes. But if you have questions or you need help, reach out, info@capforge.com, or you can give us a call, set up a time to chat. Happy to help, happy to answer questions. And if you're buying a business, before you spend all that hard-earned money and go through the stress and headache, and you want to get it checked out and make sure it's legitimate, and you can figure out what the right price to pay is and whether or not the deal makes sense, then happy to help. Hopefully this was helpful overall, and appreciate your taking the time to watch it.